What's up, guys? Welcome, guys. So today we're gonna be doing a weekly to daily to 15 minutes combo, which means we find a daily bias on the daily time frame, and then we jump down to the 15-minute time frame, and then we look for entries on the 15-minute. Okay, so that's exactly what I'm gonna do today. And yeah, I don't really have a second screen right now because I have plugged it to a different computer. But as far as I'm concerned, let's turn on this. Okay, I think we're good. Are we good? Uh, Camera's like too far away. Okay, my camera's like glitching out for some reason. Oh shit, my bad. Okay, so let me. I have a few things to go over. Right. Okay, so first of all, you can see I have my autoflow journal, which is basically my journal. And yeah, let me just stop sharing this. That way, it's easier. So first of all, this is my journal, and this is also the weekly time frame. So what I'm gonna do is I'm gonna actually just go towards what's that? Yeah, but I had it. Come on, man, I had it nice, but for some reason it's all good. So as you can see, this trade. Okay, the reason I took this trade, I didn't actually take this trade, but basically, the reason I this trade was technically entered is because of let me go through the reasoning, right? So first of all, we had this liquidity, right? But basically, if it doesn't retrace to the previous day's candles, previous day candles, 0.5, that means it's basically going in the other direction, or it has a lot of. It could mean two things: going in the other direction, or it could also mean that we're technically, headed towards headed bullish, right? The displacement is super high, like super high to the point like there's a lot of liquidity and it's moving the markets. Or it could also mean, right? Let me show you guys. It could also mean that we have met a certain point in time where we have met a key level, as you can see. So we've met a weekly key level right here, and then we are basically sweeping the liquidity, as you can see. If it closes above, sure, but if it's not, then we have a bias that we're going to be bearish for at least like a day or two, right? So for instance, as you can see, we have swept this liquidity, we have this manipulation right here, and then we have distribution towards the previous day's low. So as in, for example, let's say right here, if I show you guys, as you can see, this is the previous day's low right here, right? So again, this needs to align with the high time frame liquidity. So again, it's basically trying to take out the Tokyo Asia lows pretty much. Okay, so the thing is, okay, so I wanted to do it in a few different ways. Let's go to AUD USD. So I'm just gonna select some random spot in time, and I will select this point. Okay, so now as you can see, what do we see here? We have the previous day's low taken out. So the next day I can expect price, right? I can expect price to retrace to the high, okay? Because we have this low taken out, okay? So boom, it almost, okay, took us out. Did it take us out? Yeah, it did take us out. So the idea is, more than this, I forgot. Okay, so not forgot, but you see right here, we have this manipulation, right? So after the manipulation, like I'm targeting the closest drawn liquidity, as in like the closest drawn liquidity as in the previous day, right? Let's say for example, like over here, okay? Once we take out this liquidity, I'm expecting price to take out the previous candles high or low, okay? Opposed and drawn liquidity. You have this first manipulation, and we displace towards this, which is basically not the rejection wick. You see the rejection wick is above that, the rejection wick, and this is the mean body, okay? Which means over here is basically where everything kind of stops, right? Because one, it's not aligning with the high time frame, okay? For example, like let's say we're going bullish, like we're pushing the market higher on a bearish structure. For example, this is where we're headed towards, right? So let's look at it in different perspectives. So as you can see, we have this manipulation because of these candles, right? We take out the manipulation and we go towards the other side. Because the reason for this is because there's no, the overall high time frame is still bearish, right? It's still bearish, and we have a weekly draw on liquidity. You see this? We have a weekly draw on liquidity right here. But this itself does not mean it's going to reverse anytime soon, right? This itself does not mean that. What I do next is I look for a OTE. I do a OTE on this range. For example, right here, you can see that this is technically not towards discount, but I would expect price to low key come down here, take out this liquidity, and then move, because I want a discount entry for all my trades. Okay, so I'm still hoping. Okay, so now we have came down to discount, and you can see this is the candle, because this one was the one that technically impulsed away and didn't come back towards discount. So this next candle, now that we're in discount, right? Now that we're in discount, this candle is the one that makes discount. We would expect an impulse away from it on the weekly. Okay, seems like it didn't. Okay, that also means one more thing. Okay, so let's say, for example, like this candle, right? This one took out this one's high, which means this candle is holding as a bearish point of interest, right? For example, because this candle did not close above this, which means this is holding as a significant key level. So if you notice on this, you can see that basically it comes to discount and then it retraces away, right? It retraces away. So if you look at the next few candles as well, it comes to discount and then it retraces away. See, it comes to discount, retraces away. Okay, same procedure over here. Comes to discount and then retraces away. Let's look at this one. Comes to discount, retraces away. Now, what does this mean about the daily time frames? That it comes to discount and retraces away. So, for example, right here, right? Let's look at this candle. So this is technically bouncing off of premium. Now let's look at, for example, right here. Now this is not balanced, but let's look at the previous one. It balanced it too much. In fact, it took out the high and then retraced away, right? So let's look at this one, for example. So 0.5, right? Came, took out the liquidity, and then impulsed away. So now what we can expect, right, is for price to come back. If it does not come back, it will come back at some point. It will come back at some point. Look, now we came back, but at this point, it's not really holding this as resistance, rather it's holding it as support, which means if I now hold this candle, because now this has closed above this inverse value gap, if you notice that one as well, right here, it closed above this inverse value gap, which means now it's using this support to go higher, which means now we're most likely at most about to retrace towards this, which also aligns with the fact that this is also a fair value gap in itself, right? This is also a fair value gap. I'm going to get rid of it just to, avoid the clutter. But let me show you guys. So this is also a fair value gap in itself. So now we will expect a retracement towards 0.5. I'm not touching this until we have a retracement towards 0.5. Come on, retrace. Almost. Does not retrace. But that gives me the conviction that at some point in time, it will come back and it will take out this liquidity. Boom. Did we take it out? Nope, not yet. Did we take out the liquidity? Nope, not yet. Not yet. And okay, so now we have taken out this liquidity. Okay, at this point in time, we have taken out this liquidity. Now I will look for this right here. Okay, so now in the next candle, I would expect price to tap back into discount, and then I would expect price to move away from it. Okay, this is where it stops. So I would expect price to come back to discount. But unless we have a revisit back to discount, I'm not planning on taking a trade. Okay, so even though this retraced away, okay, even though it was holding all these premium ranges, it wasn't really something that I would have taken. Why? Because there's a lot of discount liquidity that's not balanced out. So I would expect price to take that out ultimately at some point. Okay, so now we have taken that out. Okay, now we've taken that out. So now I would expect price to hold this candle. Okay, because we took out that liquidity. Now, okay, so technically it's invalidating it, which means it's using this to go lower. Okay, it's going lower. That means there's a lot of bearish displacement. But that also gives me the conviction that it might come back to discount. 0.5. Yeah, you don't need to know all this, because all you need is just a bias, right? But this is how you determine an accurate bias, because now we're just dipping. That's all we're doing. So we have this candle, which is technically a point of interest because it swept a bit of liquidity. So it comes back into discount, sweeps all this liquidity, and then just passes away. So basically this candle is technically like in a way, like the one that holds above the others, right? So technically we'll expect a sweep of liquidity, right? So pretty much you can see that it taps here and boom, we have that liquidity sweep, but then it impulses right after. So let's sum some things up, right? So we're retracing, we know for a fact that we're retracing towards this drawn liquidity because we have heavy pressure towards the downside. We also do see an inverse fair value gap over here. Okay, we see an inverse fair value gap right here. Now we have a range over here, which means the swing high to the swing low. This is a range, okay? Let me make sure everything's fine. This is a range. So now we have a rejection of 0.5, which means our price is now rejecting this level, which means now we have lower prices. It seems like we have a second round of inducement, okay? It seems to be rejecting further into discount, okay? Now, let's see what it does next. And it dips further after the fact that we have a run towards discount, right? Because we all need one confirmation to sort of prove the fact that we're going towards that side, right? So I'm just gonna go towards, let's say, the daily time frame. Okay, so we just need a bias on the weekly mostly, and on the daily time frame, that's when we really need stuff to be going on. So first of all, we have the sweep of liquidity, high time frame rate equals low time frame trade. So now on the next day, I would expect price to tap back into discount, but it does not tap back into discount. It rather comes here and then just impulses away, right? So again, because we have this sweep of liquidity, we take that liquidity out, right? And then we impulse away, okay? So we have this liquidity, sweeps this liquidity, takes this liquidity, previous candles, low liquidity out, and then we're impulsing away. Now, let's look at this point, for example. Right here, we have a fair value gap, okay? We have an inverse fair value gap, which is closed above, and then we have, which means we have a bullish prices. We also have a fair value gap to balance things out. We also have a range right here from this swing low to swing high. So we have a swing low to swing high. And this is a 0.5 retracement. See, comes to discount. This fair value gap seems to be directly in 0.5. So over here, you see, this is the consequent encroachment. It's rejecting this price level and shifts away, and then it moves towards the closest drawn liquidity. I never target the wicks because this is just a rejection of price. I don't consider it a valid key level. I consider it a complete rejection of price. So now we see that, boom, takes away, consequent encroachment, rejects that, goes away, right? Normal fair value gap holding, right? So now we have this towards this drawn liquidity, this high. So now we've swept this liquidity. See over here, we've swept this previous candle's liquidity. So now that we've swept this previous candle liquidity, we have an impulse right after. Accumulation, manipulation, and distribution. This in itself is easy, but when it comes to really implementing this into normal theory, that's when things get pretty difficult, isn't it? So now, as you can see, if we zoom in, you can see what happened here, right? You can see all these fair value gaps. You see this inverse value gap. If you entry somewhere here, I wouldn't personally entry from here, but this inverse value gap, once it gets inversed, as you can see, it closes above here because it was rejecting all these price levels. And once it closes above all this liquidity, that means all this liquidity, any sweeps that was supposed to happen has already happened. You know what I mean? So this rejection, once it's done with this rejection of price, if it even further swept in more liquidity and dipped, we have this inverse value gap. If we close above this inverse value gap, that's when we take the trade. You see over here, we have a inverse fair value gap. So you see how it was rejecting this price level, which means it's not closing above, which means it's not really holding this level. But then when it ultimately closes above, then we have that reasoning as to why. Okay, now, even if you entry from the top of this, once it closes above, somewhere here, you target, let's say, even if you target like the wick, the low of the wick, let's say on the daily time frame, you target the low of the wick. Where is it? Where is this price range? I have no idea. Okay, right here. So we have this wick, right? So you target the low of the wick, and you target the highs. You won't take this kind of trade, but even if you were to take this kind of trade, you have it right there. So again, this is the way you find the daily bias, right? So you see over here, we have that kind of trade. See? Again, I wouldn't really do this, but I would personally probably most likely break even at this spot, right? Second draw on liquidity partial, like right here, I would partial and let the rest of it run towards here, right? That way I don't lose any money. First of all, I don't lose any money. Second of all, I make money. Third of all, I make good money. So yeah, pretty cool. So even right here, if I target towards here, it's a 1 to 6. I don't take anything more than a 1 to 5. I don't take anything more than a 1 to 5, okay, at most. right here is a 105. Where is it? Right here is a 105. Okay, so you take this 105 and then you dip. Okay, get out the markets as soon as possible. Now we go back to the 1 day time frame, and you can see that we're impulsing away. So you see over here, we have a manipulation, we have a distribution. Now, let's see what we can do next, right? We have this high, okay? We have this high of liquidity. So if we do not close above this, that means we're still dealing within this range, okay? Let's see what it does next. Okay, we closed above, which means now we're headed towards the upside. So you can see this, it does not retrace towards discount. So I would expect price to still keep going higher, and then boom, it goes, closes above. It proves that we're bullish, but we just need good prices, right? Discount prices. So now we'll expect price to retrace towards discount. It tapped 0.5 and then boom, it's impulsing away. So you see this is a fair value gap. This is a fair value gap. And you see this sweep of liquidity, manipulation, and the closest previous day's high. Boom, goes and hits. This candle goes and hits. See? So this is the mean body right here. Boom. Now we have a rejection of price. We have this sweep of liquidity, right? But I would not trust this. I would not trust this liquidity because it tapped, it swept the previous day's low. So technically, I would not touch this kind of liquidity. So if I zoom in, so if you see right here, right, this 0.5 retracement came after the fact, okay? So technically, this is the, let me just mark out the different days. That way it's easier to sort of take this liquidity. So over here, you see, this is the previous day. Where is it? I'm confused. Okay, so this was the previous day, and this was the current day. Sorry, it's actually this one. So this is the previous day, and this is the current day. If you look in between these two, right? It retraced, but then by the time it retraced, it was actually done with the full cycle, which means I wouldn't trust this range, right? So again, this was the range, this was the high, but then it came here, which is still a considerable range, right? So again, that's why it's super important. So we should be very, very keen with like the details. So for example, right here, swept this liquidity, right? Swept this high, but it did not go lower. It rather rejected this price level, right? So it went here and then it went here, right? So it's not really a good trade because boom, it just stomped on you, right? So again, what you should be really like careful about is the fact that you have this sweep of liquidity, okay? We're aligning with the high time frame bias because we had a weekly sweep. I'm pretty sure we had a weekly sweep. So as you can see, we have a weekly sweep right here. We have a bullish bias for the next few weeks, right? So once we sweep this liquidity, because it closes above, if it does close above, boom, we have bullish prices. Now, what I would expect price to do, right? Because the sweep of liquidity, I would expect price to take out this previous candles low. Now, if we apply that in the current dealing range, right? We would expect price to go lower. So we have the sweep of liquidity, comes here, comes to discount of this price range, and then it impulses away, right? It comes, impulses away, and then boom, this one takes out, this one's high, and then it impulses all the way to the previous candle low. Again, I wouldn't trust any of these ranges, like apart from the candle bodies. Okay, boom, goes here and it hits. So if I zoom in further into these liquidity points, you see 0.5, it rejects this price level, it sells off. But that zero, right? That zero, this was directly going lower. It never came back. It came back over here. And when it did come back, you see these inverse value gap, this inverse value gap right here. Let me show you guys. Inverse value gap. So this is the first inverse value gap. So ideally, I would expect this whole area to be inversed. You see it's rejecting this price level. As you can see, even if you consider this first inverse value gap, it's rejecting, it's not really showing signs of rejection, but it's holding. So see, so if I sell from here, once it closes below this inverse value gap, if I sell from here, and if I target whatever the zero was, that's this. If I go back to daily, and if I check if my price range is correct, I think I should be able to find it. Yeah, it seems like like a half build price range. Yeah, so this is the previous day's high. Previous day, as in this one, the one that swept the liquidity. And this is the low of that day. That's basically this point right here. Parallel to that. And yeah, it's a 1 or 2. It's not really the best risk to reward, but we have a good trade. We have a safe trade. I wouldn't take this kind of trade, to be honest, but if you wanna, you can go for it. Now, let's look at this. For example, this took out this one side. I would wait for the next day. Okay, it's forming lower, which means now if we retrace to 0.5, we're selling away. So what you see what it did? It retraced back to 0.5. It retraced back to 0.5. It held this fair value gap, or even this this fair value gap right here. It held this fair value gap and then it sells off. So once it closes below this fair value gap, you see how it sells off right here. Boom. Maybe put your stops a little higher, and you can put this right here. If you want to take it towards this, you can just do that as well. See, it's sold off from there. This inverse fair value gap, this fair value gap technically, it came back, took out all this liquidity, resting liquidity in this range, and it sold off. So let's go to the daily time frame again. Okay, so you can see that this is exactly what happened in this candle. Let's look at what the next candle does. Okay, so the next candle, right, what it did was it took out this one's low and then it impulsed away, which means on the next day, depending on the nature, I need a retest at 0.5 because I'm not trying to take it yet unless we have another candle that closes above it, right? So now we see a 0.5 retracement. No, we don't. Okay, now we have a retracement, a huge retracement. But if you look at it in the opposite direction, this is a manipulation. This is a manipulation, and we have the distribution. So if you look at it in the opposite direction, you can see that price came here, right? Tapped here. Once we swept this liquidity, tapped here, and then it sold off towards the previous day's low, which was this point, right? So if you bought from here, and you put your stops at this high, and then target this point, it's a 1 or 2, which is not really the best, but got in somewhere here, boom, right here. So let's look at a few more examples, and let's see. Okay, so now this one took out the previous day's low. So let's wait for the next candle. Okay, so now this one is holding, right? One is holding, but I need a retracement. I need a retracement. Where is it? It's not anywhere to be seen, which also could mean, because it's closing above this level, right? Which also could mean that we are in fact retracing towards here. Let's see if that theory is true. I mean, it already hit that, so technically it is true. So you see that discount entry, you see discount, and follows the movement towards the closest round liquidity. Again, these are rejection wicks. These are not really there. Okay, these are just ghost wicks. Boom. We have that. Now we have this liquidity. Now we have this. So let's see what the next candle does. Came back to 0.5 and it sold off towards the previous day's low. Okay, the previous day's low in this scenario is this point. Okay, the previous day's low. So again, if you got in somewhere here, this is not really a great trade, to be honest, because the risk reward is not there. So yeah, but either way, yeah, it's not really a trade that I would have taken. But we have a sweep of liquidity. Now let's see what the next day does. Okay, so the next day is now formed. Let's see what it does. 0.5, it's over here, it's rejecting from here, right? You do that, you put it here. Let's see what it does. Sold off. Cool. So we're not going to be right all the time. That's fine. Over here, we swept this liquidity. Let's see if it's holding 0.5. 0.5 is holding. Now, if we buy from here, if we target this high, will we go in this direction? Let's see. Boom. One candle. Now, if we target, we target this wick because it swept all this liquidity and it's rejecting this price level, which means we have bearish prices. Now, in the next candle, which is this one, let's hope to see discount prices. Sell from here. Target whatever the previous candle's low is, which means in this case it will be this one. Boom. Goes and hits that level. So now let's go towards this candle, which is, I need a next candle because this swept this swept this one's candle liquidity, but I don't want to be trading during this day. I want to be trading during the next day, depending on the discount range. Boom, discount. Impulse towards the closest drawn liquidity. In this case, the previous day was here, but let's expect price to chase up to this point. Okay, so let's see. Boom, just like that. So the next day, because they swept this candle's high, and it did not close above its rejectance level, I would expect bearish prices again. Okay, so now we have a closure above that. Okay, which means it's not holding 0.5. Okay, so let's zoom in to this kind of example. So let's zoom in. So now I'll go towards this one and I'll mark this one. So now we have a range of price, which means you see there's no retracement away from anything. See, this inverse value gap was not holding really, because if it was holding, it would have came and they would have held. This is not really holding. This is rejecting. Like it went and impulsed. It took you out, but you could have gotten taken. You could have gotten stopped out, but again, that's part of the game, right? So you see over here, you have this candle right here. So the next candle, boom, 0.5. It's rejecting 0.5. So if I sell from here, if I target the previous candle's low, which is in this case it would be this one, but let's target up to here. Doesn't work like that. Interesting. Because the previous day's low is the only thing that really holds. Interesting. That's interesting. Because if you look at it in the other way, this is 0.5. It's holding it as support. It's sweeping the liquidity. It's also, you see over here, this candle swept this candle swept this one's liquidity, which is also giving me bullish prices. But see, this wicks went and hit this drawn liquidity. And then it again had a liquidity sweep. Let's see if this holds. It holds this price level and it's sold off towards the low of the body. So technically it's just moving away. You know what I mean? There's no more bodies here, right? So it just sold off to this point, which was the previous day, right? So this was the candle. It was holding. That's the previous day is here. My bad. So this was the candle that we were judging off of. This was the previous day of that candle. So we come to discount here and then we sell off to this previous candle's low. So let's look at this one, for example, right here. So now we have this candle. So let's go to the next candle. Okay, so let's see if it's holding 0.5. How well is it holding 0.5? Okay, it's rejecting its price level, which is technically this is the previous candle. So yeah, in this case, it just swept all this liquidity over here, right here. This liquidity was swept totally. So because of that, I would expect price to go and hit this drawn liquidity, right? This drawn liquidity. So even if we do this, and boom, we went and hit this point, right? So the idea is the risk rewards are not really the best. That's why I'm still skeptical about this trading plan, but it's a pretty good trading plan if it's like, you know. So either way, let's say over here, okay, let's try it a few more times on Euro USD, which is a commonly traded pair. So let's say over here, we'll use, okay, let's move to like a random spot in time. Okay, so let's say over here, okay, so what do we see here? Seems like we're bearish. That's one observation. There's an inverse fair value gap. So it seems like we swept this liquidity over here, but I don't trust these ranges at all, actually. I'll see if it held 0.5. It did hold 0.5 and it sold off from it. But over here, you will see that there is a retracement from this point. So I would hold, let's see what this 0.5 candle, okay, you can see that this 0.5 candle, see how it's holding this. So obviously this is discount. So I would expect price to low-key tap again. And you see it's selling off. So the reason for this, right? So you see this previous candle's high. So you see the previous candle's high, liquidity sweep, and this previous day's low, taken out, right? But then as much as it took out this range, it didn't, right? Because if we mark out these two candles, you will see that this is not really taking out the liquidity. It's rather just coming back. You know what I mean? It's just coming back. It's not taking out the liquidity. Because that momentum really did take out this level. It didn't retrace anymore. So there's no proper trade here. There's no proper trade here. So the idea is that you need a sweep, a distribution right after. But in this case, we take out this liquidity. Let's look at the next candle. Fair enough. So does not hold. Obviously, it does not hold, right? Took out this liquidity and took out even more liquidity from this range. Right? Took out even more. So now, if we see this candle holding, right? We see this candle holding. No. Seems like it's not. So now we have more liquidity, right? More liquidity taken out. So now, what do we see next? We have a rejection. We still have bearish prices. It's just taking as much liquidity as possible. So now we have a rejection from 0.5. We target this. Previous day's low is technically this point, so it doesn't really make sense. So, I mean, it hit that, right? So, again, we have what? I would expect this low to be taken out, to be honest, because I'm not willing to take any chances before that. So, yeah, there we go. So all this relatively equal lows were taken out. And now we will expect this candle to hold price. Let's see if it does. Seems like it's rejecting off of 0.5, which means there's bearish prices. Let's see what this candle does. Okay. Let's see, let's drag it over here. Yeah, so let's see what this candle does next. It's holding 0.5. So it's holding 0.5, which means now we have bullish prices. We have bullish prices towards what? The previous day's high. So again, it goes and stinks directly. So it doesn't really make sense to take that cut, right? Again, we took out that low. Look at that. Right after it takes out the previous day's high or low, it just goes and takes out more liquidity. So you can see over here, we have this rejection. So once we see this next candle, we'll be the judge of that. Okay. Seems like this was the previous low. Took out and then dipped, right? So this, let's see if it's holding 0.5. Is it holding 0.5? I would say so. And then this is the previous day. This is the previous day. So it doesn't really make sense. Take it. If this is holding, but it still does not make sense. So either way, if let's say, for example, like right here, we see a rejection of price, and we target like here, still doesn't make sense to take it there. It took out this liquidity before going this way. So it doesn't make sense. Now let's look at the 4 hour. Let's see. So it seems like we have a manipulation. We have a draw on liquidity right after. So of course we have this liquidity sweep. We have a retracement towards the closest draw on liquidity. Interesting. So now we have this liquidity sweep and 0.5 retested. We have a retracement towards the closest draw on liquidity. So I'm pretty sure it's off of 0.5. So if it's rejecting 0.5, then we can safely assume that it's going towards the opposing draw on liquidity, especially after a liquidity sweep. See? So let's see if that theory is correct. Okay. So let's see if that theory is correct. I want to get a different video of this. So now let's retest and see if the 4 hour bias is correct. So now I'm expecting price to sweep all this liquidity. Okay, we have a sweep of liquidity. Now we have what? This liquidity right here. Okay, so let's expect 0.5 to be holding from this candle right here. 0.5 is holding. So I would buy from here. I put my stops here. And then I would buy towards the opposing draw on liquidity, which is very unlikely. Very unlikely. And it did that. Okay. It was very unlikely because it does not resonate with the whole overall bias. It's bearish over here. Let's draw the support and resistance lines. Let's see. And resistance is over. See? So if you go back, if you tap back, boom. See? Support and resistance, as far as support and resistance goes, you can see that these lines right here. So you see, takes out the support and resistance traders. So yeah, pretty much as far as the liquidity wise goes, let's hope for So we have a sweep here. So let's expect price to still bearish, to be honest. It's not really bullish. But you could expect price to go towards the closest draw on liquidity though, which is this point. It doesn't really make sense though. But let's see if it hits this overall draw on liquidity, which it did, but it's not really all that right. So let's see. 0.5, let's see if it's retesting 0.5. It did come back, it swept as much liquidity as possible, and then it retraced away. And you can see that this is the inverse rally gap. Hold. Okay, so now we have a, let's say if I sell from here, if I target the opposing draw on liquidity, let's see if this works. Or if this is the worst strategy. Doesn't seem like it works. Does not seem like it works. Right? Does not seem like it works. Because in this case I would say, because did we sweep like a weekly target? It seems like we swept a weekly target, okay. So we swept this previous week's low, and we overall swept this target as well. So I guess in this case we are bullish, but let's go to the 4 and so as you can see, so if we consider the normal way of looking at things, it's basically the tap in the fair value gap and then retracing away, right? But the thing is, it's in a way, like if you are, let's say for example, like buying from discount, and then you're like basically buying towards this, in a way it's kind of, I don't know, it's not really my cup of tea. Because let's say you buy from like, see, this would have almost lost, right? And it's say you hold this, you hold this level, you see this 50% encroachment being rejected, you target the draw on liquidity, and you target whatever the closest DOL is. It's 2.2, which is not bad, but it's not really good either, right? So I'm not trying to catch a home run, but I'm trying to catch a 1 to 3 minimum, right? So we can see that there is a fair value gap here, and we have a rejection of price. So I would expect over here to reject price. So you see there's an inverse rally gap here. So you could sell off of that, I mean buy off of that as well. See, in this case I would probably wait for a retracement because my risk reward is probably gonna be really bad if I have to target here and then I have to target here as my liquidity. It's nothing, right? So yeah, honestly not the best idea for a trade, but because this is the closest draw on liquidity. I mean, even if you target like here, which I don't recommend targeting any of the wicks because these are price rejections. Let's say because we're bullish, right? We're obviously bullish. We're going towards, you know, we have shifted structure from this point. Like from this point onwards, we've shifted structure and we're holding this. I will say it's fair value gap rejection, fair value gap, boom, impulse away. So it does make sense, but it doesn't make sense at the same time. So now you can see that there is this candle right here, so we can judge off this candle as well. We will expect price to retrace down towards 0.5. Doesn't seem like it retraced. Okay, that's okay. Doesn't always happen as well. So seems like we're holding point. Seems like we're holding an inverse rally gap, but we have a sweep here. Yeah, we have a liquidity sweep and we have this impulse away from it. So yeah, as far as I'm concerned, you can, but you have the sweep of liquidity, you have this inverse fair value gap holding, but this candle, because it swept the liquidity, right? If it's holding 0.5, I would expect it to hold. So it seems to be rejecting 0.5, which is a good sign, which means even if you buy from, like, let's say 50%, target whatever the low, whatever the high of liquidity. Yeah, this is the closest draw on liquidity, so you target this as your draw on liquidity, 2.7 out of this trade. This is a manipulation. This is a rejection. But again, if we are bullish, which also means that this fair value gap in itself could be holding, isn't it? Fair value gap could be holding. So I would expect this 0.5 to be sort of met again. So again, I'm not expecting this to go towards the opposite draw on liquidity because that's kind of unrealistic unless we have, let's see if we have a retracement back to 0.5. Okay, so now we have a retracement, but I'm not expecting this to go back. See, just like I said, I'm not expecting this to go towards the opposite draw on liquidity. The reason is generally because we're bullish, right? Look at it from the arguments perspective. We have a bullish fair value gap. We come to 0.5 and we reject from here. Based off this candle right here towards the, let's say right here to be safe, 0.5, right? Let's say you bought from here, put your stops here, target the drawn liquidity 1.65. Again, not so great, is it? Now supply and demand, honestly, I would say supply and demand, it kind of works, but I don't really see supply and demand working for me. Because this is a supply and demand zone. It's like very less trades. But it's good that there's less trades. But it's also like, let's say for example, right here. It's rejecting this level. I mean, you could refine supply and demand. That's like the usual. That's like my first strategy, to be honest. And you can take it towards the opposite draw on liquidity. That's possible. I'm not saying it won't work, but if I play price forward, you see, you just get stomped on, right? So I guess supply and demand works on certain assets, but as far as I'm concerned, not really. So it's basically off of liquidity mostly. So yeah, that's pretty much what I need to do. It's almost 41 minutes, 42 minutes of this. Yeah, I hope you guys enjoyed. I hope you guys got a different perspective. This was kind of a mess, to be honest, but I hope things will be better. And I'll see